I made my fortune by seeing what others could not because I was smarter, but because I was willing to accept something most investors refuse to acknowledge, that markets are fundamentally irrational, driven by human psychology rather than mathematical certainty. In 1992, I bet $10 billion against the Bank of England. I won. But that trade wasn't about being right, it was about understanding that the people managing the British pound were prisoners of a broken system, and they knew it. Today, I want to share with you why most investors fail, not because they lack intelligence or resources, but because they misunderstand the very nature of markets themselves. What I'm about to tell you contradicts everything taught in business schools, but it's how I turned ideas into billions. My name is George Soros, and I've spent over 6 decades in the financial markets. I'm known for breaking the Bank of England, for my quantum fund, and for philosophical ideas that most people find confusing at first. But at the core of everything I've done is one simple insight. Markets are not rational mechanisms that process information efficiently. They are reflexive systems where perception shapes reality and reality shapes perception in an endless feedback loop. For those unfamiliar with finance, let me clarify what I mean. Traditional economic theory, the kind taught in universities, assumes that markets move toward equilibrium, that prices reflect all available information, that investors are rational actors making calculated decisions. This is called the efficient market hypothesis, and it dominated thinking for decades. I built my career proving it wrong. You see, I didn't approach markets as a mathematician or an economist. I approached them as a philosopher who understood that human beings are fallible, that our perceptions are flawed, and that this fallibility creates opportunities. The crowd believes one thing, reality is another, and in that gap between belief and truth, fortunes are made. But here's what most people miss. I didn't just profit from being contrarian. I profited from understanding when the crowd's beliefs would collide with reality. Timing isn't everything, it's the only thing. And timing requires understanding something deeper than spreadsheets and charts. Let me start with the concept that changed how I see everything, reflexivity. In the natural sciences, there's a clear separation between observer and observed. A chemist studying a reaction doesn't change the reaction by observing it. But in financial markets, the observers are the participants. What investors believe about a stock changes the price of that stock, which then changes what investors believe about it. It's a two-way feedback loop. Think about a housing bubble. People see prices rising. They believe prices will keep rising, so they buy more houses. This drives prices higher, confirming their belief. The belief creates the reality. But here's the critical part. This process isn't stable. It's self-reinforcing until it becomes unsustainable, and then it reverses catastrophically. I saw this pattern everywhere. In the 1970s, I recognized that real estate investment trusts were undervalued because investors didn't understand their true worth. But as more people realized this, prices soared beyond any reasonable valuation. The initial insight was correct, but the market's response created a new distortion. In the opposite direction, this is reflexivity. Markets don't move toward truth. They oscillate between extremes of undervaluation and overvaluation, driven by waves of human perception. Most investors look for the right price. I looked for the point where perception was so divorced from reality that a violent correction was inevitable. What I did with this understanding surprised even me. September 1992. The British pound was pegged to the German Deutschmark through the European exchange rate mechanism. But Britain's economy was weak, inflation was high, and interest rates needed to fall, not rise. Germany, meanwhile, had just reunified and needed high interest rates to control its own inflation. The system was broken. Britain couldn't maintain the peg without destroying its own economy. Here's what most people misunderstand about that trade. I didn't break the Bank of England through some act of financial violence. The system was already broken. British policymakers knew it was broken. The market knew it was broken. Everyone was waiting for someone to admit it. I simply bet that reality would eventually overpower the political commitment to maintaining an unsustainable policy. I built a short position worth about $10 billion against the pound. This wasn't reckless gambling, it was asymmetric risk. If I was right, the pound would devalue sharply, and my position would generate enormous returns. If I was wrong, the downside was limited because the peg itself limited how high the pound could go. On September 16th, Black Wednesday, the Bank of England spent billions trying to defend the pound. They raised interest rates. They bought pounds. Nothing worked. By evening, Britain withdrew from the ERM, and the pound collapsed. I made over $1 billion in a single day. But here's the deeper lesson. I didn't predict the future. I identified a fundamental imbalance and recognized that imbalance is always correct, eventually. The only question was timing, and I positioned myself so that if the timing was right, the payoff would be extraordinary. This trade made me famous, but it also made me controversial. People asked, is it ethical to profit from a country's economic crisis? My answer was simple. I didn't create the crisis. Policymakers did by maintaining an unsustainable peg. I simply recognized reality before others were willing to admit it. What happened next shaped my entire philosophy about boom-bust cycles. Markets move in boom-bust cycles because human beings are trend-following creatures with limited rationality. Let me explain the typical pattern. First, there's a new trend, a technological innovation, a policy change, an economic shift. Early investors recognize the opportunity. Prices rise moderately based on genuine fundamentals. Then comes the critical transition. The trend attracts attention. More investors pile in, not because they've analyzed the fundamentals, but because they see prices rising and don't want to miss out. This is the boom phase. Prices rise beyond any rational justification. Valuations become absurd, but the boom continues because the price rise itself becomes the justification for buying. Eventually, someone asks the obvious question, does this actually make sense? Maybe one company misses earnings. Maybe interest rates change. Maybe there's simply no one left to buy. The trend stalls. And then psychology reverses. The same investors who were buying recklessly now panic. They sell not because fundamentals changed, but because the price momentum reversed. Fear replaces greed. The bust is often more violent than the boom was exuberant. I saw this in the dot-com bubble. I saw it in the 2008 financial crisis. I'm seeing it in markets today. The key insight is this. These cycles are predictable in pattern but not in timing. You can know a bubble exists months or even years before it bursts. The challenge is maintaining your position until reality catches up with perception. In the late 1990s, I recognized that internet stocks were wildly overvalued, but I also recognized that bubbles can inflate far beyond reasonable expectations before they pop, so I played both sides, profiting from the momentum on the way up while preparing for the inevitable collapse. Most investors can't do this. They're either perma-bulls who ride bubbles to destruction, or perma-bears who short too early and get wiped out before being proven right. Success requires flexibility, humility, and the ability to hold contradictory ideas simultaneously. This brings me to the most misunderstood aspect of my approach. Here's something most people don't know about me. I'm wrong constantly. The difference between me and most investors isn't that I make better predictions. It's that I survive my mistakes. Let me give you an example. In 1987, I was convinced that the Japanese stock market was overvalued and would crash. I shorted it aggressively. I was right about the overvaluation but wrong about the timing. The market kept rising. I lost money, a lot of money. But I survived. How? Because I never bet everything on one thesis. I managed risk religiously. I sized positions so that no single mistake could destroy me. And when I realized I was wrong, I cut my losses quickly rather than doubling down out of ego. This is the most important lesson I can share. Embrace your fallibility. You will be wrong. Your models will fail. Your predictions will miss. The market will humble you repeatedly. The question isn't whether you'll make mistakes, it's whether you'll survive them. I developed a simple rule: when you have a position, constantly ask yourself, what if I'm wrong? Not as a hypothetical exercise, but as a genuine risk management tool. If you can't afford to be wrong, your position is too large. During the 2008 financial crisis, I saw the mortgage crisis developing early. I positioned the fund defensively and made certain bets against financial institutions. We did well, but I also missed the full magnitude of the collapse. I underestimated how interconnected the system had become, how fragile the leverage was. I was partially right, which was enough to profit and protect capital, but I wasn't completely right, and that's okay. Survival isn't about perfection, it's about being more right than wrong, and managing your exposure so that wrong doesn't destroy you. This mindset separates successful long-term investors from everyone else. Most people can't admit mistakes. They hold losing positions, hoping for a reversal. They add two losers to average down. They confuse stubbornness with conviction. I confused them too. Early in my career, I learned the hard way that the market can stay irrational longer than you can stay solvent. Now I cut losses ruthlessly and let winners run. Simple but psychologically difficult for most people. So what can you take from my decades in the markets? First, understand that markets are reflexive, not rational. Prices are shaped by human perception, which creates feedback loops. These loops lead to extremes, bubbles, and crashes. Your job isn't to predict the rational price. It's to recognize when perception has divorced itself from reality and position yourself for the inevitable correction. Second, identify structural imbalances. The Bank of England trade wasn't genius. It was recognizing an unsustainable policy commitment. Look for situations where economic reality conflicts with policy or market sentiment. When the gap becomes too large, bet on reality winning. Third, manage risk obsessively. Size your positions so that you can be wrong and survive. Cut losses quickly when your thesis is invalidated. Never, ever bet everything on one outcome, no matter how certain you feel. Fourth, embrace fallibility. You will be wrong, accept it. Build systems that assume you'll make mistakes and protect you from catastrophic losses. Humility isn't a weakness in markets, it's a survival mechanism. Fifth, timing matters more than being right. You can correctly identify a bubble and still lose money if you act too early. Patience, positioning, and catalyst awareness are crucial. Sometimes the right move is to wait, even when you know where things are headed. Let me ask you something. What would you do in my situation? If you saw an obvious imbalance, a currency peg that couldn't hold, a bubble inflating beyond reason, a policy destined to fail, would you have the conviction to bet against the crowd? Would you have the discipline to manage the risk? Would you have the humility to admit when you're wrong? These aren't easy questions. I've spent my life grappling with them, and I still don't have perfect answers. But I do know this: the investors who succeed over decades aren't the ones with the best predictions. They're the ones who understand human nature, who recognize patterns of boom and bust, and who survive long enough to profit from inevitable corrections. Markets are not machines. They're crowds of fallible humans, driving prices based on flawed perceptions, creating feedback loops that amplify both greed and fear. If you understand this, truly internalize it, you'll see opportunities that others miss. I want to hear your thoughts on this. Do you see markets as rational mechanisms, or do you recognize the reflexive patterns I've described? Have you experienced the challenge of being right too early, or the temptation to hold losing positions out of pride? Comment below, share your experiences, your questions, your disagreements. The best investors are continuous learners, and I learn from engaging with different perspectives. And if this resonated with you, consider what other aspects of markets are misunderstood. Perhaps we'll explore those next. Until then, stay curious, stay humble, and remember, in markets, survival comes first. Everything else is secondary.